Most commercial real estate investors don't lose money because the market crashes. They lose money because they underestimate one number, not the purchase price, not the interest rate, not even the rent. The number that quietly kills deals is debt service coverage. And if you get it wrong, a property that looks like $1 million opportunity can turn into $1 million mistake. Commercial real estate can build serious wealth, but it can also destroy capital fast if you don't understand how the deal actually pays for itself. A lot of investors focus on the wrong thing. They ask, can I buy this property? But the better question is, can this property safely carry the debt, expenses, vacancies, repairs, and still produce cash flow? That is where many investors get into trouble. The biggest mistake many commercial real estate investors make is focusing only on the purchase price. They see a building listed for $1 million and immediately think, can I get it for $900,000? Or, what is the price per square foot? Those things matter, but they are not the whole deal. A cheap property can still be a bad investment, and an expensive property can still be a great investment. The price only tells you what you're paying. It does not tell you whether the asset can support itself. That is why experienced investors look past the purchase price and focus on the operating numbers, the rent, the expenses, the vacancy risk, the repairs, the loan payment, the cash left over after debt. Because in commercial real estate, the property is not valuable just because it exists. It is valuable because of the income it produces. Commercial real estate is usually bought with debt. That means the property has to do more than generate rent. It has to generate enough rent to pay operating expenses and make the loan payment. That loan payment is called debt service. Debt service includes the principal and interest payments owed to the lender. If the property does not produce enough income to comfortably cover debt service, the investor has a problem. Maybe the rent is too low, maybe the expenses are higher than expected, maybe the loan terms are too aggressive, maybe there is a vacancy. Any one of those can turn a positive-looking deal into a negative cash flow property. And once the property is negative cash flow, the owner has to feed it with outside money every month. That is how investors get trapped. They buy a property because the purchase price looked reasonable, but they fail to ask whether the income can safely support the debt. This is where DSCR comes in. DSCR stands for Debt Service Coverage Ratio. It measures how much income the property generates compared to the loan payments. The formula is simple. DSCR equals net operating income divided by annual debt service. Net operating income, or NOI, is the income left after operating expenses, but before the loan payment. For example, if a property produces $120,000 per year in NOI and the annual debt service is $100,000, the DSCR is 1.20. That means the property produces 20% more income than needed to cover the loan payments. A DSCR of 1.00 means the property barely covers the debt. A DSCR below 1.00 means the property does not produce enough income to pay the loan. Many lenders want to see a DSCR around 1.20 to 1.35 or higher, depending on the property type, borrower, and risk. But as an investor, you should not only care about what the bank requires, you should care about what protects you, because if your DSCR is too tight, even a small problem can wipe out your cash flow. Let's look at a simple example. An investor finds a commercial building for $1 million. The property brings in $10,000 per month in rent. That sounds strong. That is $120,000 per year in gross rent. But gross rent is not cash flow. Now subtract expenses: property taxes, insurance, repairs, maintenance, utilities, management, vacancy allowance. Let's say the property has $35,000 per year in operating expenses. That leaves $85,000 per year in NOI. Now the investor finances the property. After the down payment, the annual loan payments are $78,000 per year. At first glance, the property still looks positive. $85,000 of NOI minus $78,000 of debt service leaves $7,000 per year. But the DSCR is only about 1.09. That is extremely tight. One vacancy, one roof repair, one insurance increase, or one tenant paying late can wipe that out immediately. Now imagine the investor thought they were buying a great deal because they negotiated the price down from $1.1 million to $1 million. They saved $100,000 on paper. But they bought a property with almost no margin for error. That is the mistake. The deal was not bad because of the price. The deal was bad because the cash flow was too thin for the debt. To avoid this mistake, analyze commercial real estate backwards. Do not start with the purchase price. Start with the income. Ask, what is the current rent? Is the rent real or just projected? Are the tenants stable? Are the leases short-term or long-term? Are expenses accurate? Are taxes likely to reset after purchase? Is insurance going up? What repairs are coming? Then calculate NOI. After that, calculate the debt service based on realistic loan terms, not best case terms, realistic terms. Then look at the DSCR. If the DSCR is too tight, you have three options. You can negotiate a lower price, You can put more money down, or you can walk away. Walking away is sometimes the most profitable decision you will ever make, because the goal is not just to buy commercial real estate. The goal is to buy commercial real estate that survives stress. A good deal should have room for problems, room for vacancy, room for repairs, room for rate changes, room for the unexpected. If a deal only works when everything goes perfectly, it probably does not work. The purchase price gets the attention, but the cash flow determines whether the investment survives. That is why DSCR matters. It tells you whether the property has enough income to carry the debt safely. Before buying a commercial property, do not just ask if the price looks good. Ask if the income supports the loan. Because in commercial real estate, one overlooked number can be the difference between building wealth and buying a financial disaster. Subscribe for practical lessons on business, commercial real estate, and the deals that make or break wealth.